Welcome to PitchIt, the Fintech Startups Podcast. One founder, one startup, one investor at a time. I'm your host, Todd Anderson, Chief Content Officer, Fintech Nexus. On episode 56, I talk with Pat White of Bitwave. Bitwave unlocks digital assets for enterprise finance. Bitwave combines tax and accounting capabilities with workflow and process expertise, allowing enterprises to survive and thrive in the financial revolution made possible by cryptocurrency. And crypto continues to have its ups and downs. Even since this recording, many believe that we're headed for another crypto winter. I'd say the difference this time, maybe in past crypto winters, is there no longer feels like crypto itself, blockchain-based digital assets, as if they are a possibility, as they might happen. I mean, everyone's pretty much on board with this is the future. How that might take shape is still anyone's guess, but I think we're on a significantly different footing today than we might have been 2017, 2019, 2020. Pat and I dig deep into the current market turmoil, what potential impacts the downturn might have on fellow founders, investors, how a simple transaction of, say, sending someone a Bitcoin might have 5, 6, 7 after effects for an enterprise, raising capital, and a whole lot more. I hope you all enjoy the show. Welcome to the podcast, Pat. How are you?
Oh, I'm doing great, man. Thanks for having me on.
Of course. So first, just want to start with, tell us a little bit about yourself, professional background, kind of what's brought you to your current venture, which is Bitwave.
Yeah. So my name is Pat White. I'm the CEO of Bitwave. Bitwave is a digital asset tax and accounting platform for businesses and enterprises. We'll talk a lot about that because it's intimately tied to the question you just asked about how we all kind of got here. But so my background since I'm 20 years old was in enterprise software. My first job out of college was with Microsoft, and I've been at a bunch of enterprise software companies. So I'm a longtime enterprise software computer engineer and architect and things like that. So I'm a engineer by training. I program. I still program a lot. So we're a big team at this point, and I'm still fingers on keyboard every day. But that's just because I like it. It's kind of fun. I got into crypto. So one of my jobs was working for a company called Fortify Software, which was in the enterprise security space. We did a code analysis tooling for businesses that write the right code and want to make it secure. So I ended up on a bunch of the crypto mailing lists back when that meant something different. So that was back in the day when there were these cryptography mailing lists, and there were just a bunch of math nerds talking cryptography. It was super interesting stuff. And then I was on one of those lists when Satoshi published the white paper. So I got it pretty early. I thought it was fascinating. I thought it was really, really interesting because I think people forget that it is a computer science research paper first and foremost. So at this point, I almost think we tend to think about an economics paper or a credo or some libertarian rallying cry. But in fact, it is, and it's in the very heart of it. It is a computer science research paper about how to solve this really hard problem, which is the Byzantium generals problem or distributed. It's how do you solve untrusted people all contributing to something?
Yeah,
and that's super important because people kind of forget about that part of this. It's at the core of so much around crypto. But people tend to think about everything else besides this really hard computer science problem, because when I tend to think about the really interesting problems that are being solved today, I think about how you apply that computer science problem. We'll talk about that later. So anyways, I saw the white paper, thought it was fascinating. I set up a little mining rig. So I bought a nice GPU. I got an AMD Radeon at the time was the best mining GPU. I ran two of them. My thinking at the time, it's so interesting because I feel like I learned a lot from that, which was I I wasn't sure what was going to happen with all this crypto stuff. I'm like, oh, this is kind of crazy. So
Mhm.
I'm like, well, what I'm going to do is I'm going to build a little mining rig. And the worst case scenario is that I'll have this like nice gaming PC, because essentially there was a very high overlap at that time between mining rig and gaming PC. So I got this like what is essentially like a $5,000 like gaming rig, which is and use it to mine some Bitcoin. I never mined very much, but if I just bought $5,000 of Bitcoin, like I'd be sitting on a beach, like we'd be doing this from I'd be in a swimsuit right now for this interview. So it's one of those really funny things about like asymmetric risk modeling in your own brain. So got into Bitcoin back then, thought it was really interesting, thought it solved some really interesting problems within the world, because it's hard to imagine that I tend to think about the Bitcoin when you get to the economics of it. I tend to think about it in terms of reserve currency of the world, because there is going to over time necessarily be a lot of pressure against using the US dollar as a reserve currency. And I tend to think that it won't be the US, if it's not the US dollar, which it's going to be a while until that's the case, but like if it's not the US dollar, it's definitely not going to be the yuan. Like no one's going to adopt the yuan. That's crazy talk. Even the euro is really tough. Like the way the ECB runs, where it's beholden to kind of both nobody and everybody, it would be hard to imagine the euro stepping up as a reserve currency. So it's very natural that some other asset will kind of pick up the reserve currency status. And so I think that that'll end up being Bitcoin over the very long term. So I like that piece of it. And then like 2017, I was working on another startup. We sold that to Cisco, ended up finishing up my vest time at Cisco. And I'm like, hey, let's go do something fun. So I looked at the space, and it was time for there to be a enterprise software play in digital assets. Like before then, there wasn't. Like 2010, there weren't enough businesses using crypto to be an interesting like startup in the space. 2017, that's when you have like the NYDIGs of the world, the Galaxy, Chainlink, all the ICO stuff. That's when we ended up kind of starting and getting going, and the rest is sort of history. So we've built, like we started out very simply to build, the startups, like the vision for the startup has never actually changed, which was the vision is to help businesses solve problems that they're going to run into around digital assets. Right. So if you are a business that wants to adopt digital assets for whatever reason, like your MicroStrategy where you have an ideological reason, or your Nike where you have a very pragmatic reason that you need to defend your brand in the metaverse, you as a business adopting digital assets will have a bunch of different problems you run across. You'll have problems around accounting. You'll have problems around tax. You'll have problems around treasury. You'll have problems around your FP&A. Like there are just all these different problems that businesses run into once they start using digital assets. And our mission is to help them solve those problems.
Now, you personally, did you always see yourself as a founder? You mentioned working for Microsoft and enterprise companies. I mean, was your path always eventually leading to becoming a founder yourself? Or did it, the other category, which a lot of people fall into, is we found this problem that didn't really have a solution to it, and me and my co-founders, created the solution, kind of fell into being a founder?
No, I'm a longtime startup guy. So Bitwave is probably my fifth startup. They've had varying levels of success. I sold Sonata, was my previous startup, sold that to Cisco. The one before that did well, but just kind of petered out. So yeah, it's for me, it's I love doing startup work. Like I love the process of startups. I love crypto. I love engineering in general, but startups are like, I almost think in some ways that that's my job. Like my number one job is I'm very good at startups, more so than almost anything else, because it's a really special trait. Like it is this being able to kind of like identify the problems that are worth solving is very difficult. Like,
and to take on that risk of actually doing something about it. There's a lot of people that think about problems and say, oh, I have this idea, but then they don't take the step to, either form a team or go to an investor and say, hey, here's how we'll solve this problem. It takes, a set of stones, to a lack of a better term, to begin to step up and say, all right, I'm going to take this chance, this opportunity, this risk, and I'm going to try to solve this problem.
But, and I think part of this, I actually think that people in general are incredibly bad about risk analysis. I mean, I think we've proven that, right? Like global warming is humanity being very bad about risk analysis at a large scale.
Yep.
And I think that falls in play for startups, is that people tend to think about startups as high risk endeavors. And they are. I mean, don't get me wrong. Like, we bootstrapped it. I wasn't paying myself for like 6 months or something like that. And there is this aspect that no startup will ever be successful. Like, the number one bit of advice, I give 2 bits of advice about startups to people that are interested in this kind of stuff. The first is, it is essentially impossible to do a startup while you're working part-time on it. It's possible. Don't get me wrong.
Everybody, almost every founder I've ever talked to said it's either you're giving your all to it, or and even then, your chances of success are not very high. But those that don't give all to it, and this doesn't necessarily mean you have to work 300 hours a week, but giving every ounce of your work day and your work life to it, doesn't give you the biggest chance of success. And those that try to do it part-time,
100%.
Yeah.
And it's not even just that. It is a mental state of mind. Like, at the end of the day, startups are incredibly hard. Like, for any startup, they may seem easy. It may seem like it just happens. It is incredibly difficult. It's incredibly stressful. And if you have a path of least resistance, which is just to show up at your consulting gig and get paid 5 times more than you're getting paid at a startup, it is really hard to stay focused on getting the startup over the finish line. I say finish line, but really the point of a startup is to get over the starting line, to the point that then it turns into something that you can run for a while with. So that's my general piece of advice for anyone who wants to do startups is you have to burn the boats on the beach. That's a really important part of it. You eventually have to go full-time in your startup, or it'll just never be successful. And the other one is it is a roller coaster. Like, you have to adopt a very Zen Buddhist approach to life as a startup founder, because literally day after day, the best thing in the world and the worst thing in the world will happen. Like, you will raise an enormous round, and then like your early engineer will quit, and then you'll like close the biggest customer, and then your software will be like, you'll have an outage for like a week. Like, it's not that that's ever happened for us, obviously, but like it is one of those things where like it's this constant of extremes between the hardest thing and the best thing and the worst thing happening day after day, which is kind of funny, because there's almost this part of me that, like, I had a really bad day a couple of weeks ago, and I was like talking to my co-founder. I'm like, well, that sucks, but like, tomorrow's gonna be a really great day. Like, you almost get in this mentality where you're like, the bad things will always have something good following, but then you also don't appreciate the good things as much, because you're like, crap, what's gonna happen tomorrow? Like, what's my karma? What's my galactic karma that I'm going to pay for this really good thing happening?
Well, speaking of really bad things happening, obviously, it'd be hard not to record this episode without talking about current market in crypto. We've obviously seen not only prices come down. We've seen big issues with algorithmic stable coins and Terra, and then this week you get a lot of the big names in crypto.com, Coinbase, and others beginning to lay off workers. And there is this narrative of another crypto winter, but as someone who's working in the space and talking to people and has products that are helping people, bring digital assets into their enterprises. What are your thoughts about kind of what's going on in the space today, and what that might mean going forward? Will it have a cascading effect where regulators get more skittish and legislators begin to say, hey, if this thing can happen so quickly, should we put, pretty high guardrails on the system and stuff like that?
It is super interesting. So what I will say first and foremost is, one of my favorite quotes about this is, if people are podcast people, there's Kai Ryssdal, he does Marketplace at NPR. It's a daily release on NPR about just the economy and things like that. And one of his favorite quotes is the stock market is not the economy. And I think that is incredibly appropriate for crypto in general, which is that the price of Bitcoin is not the Web3 economy. Like, it is certainly an indicator, and people, like, I'm not going to lie, like, people show up to work a little bit sadder the next day when Bitcoin hits 21,000. Like, we don't have a lot of people like throwing out funny memes today in the Slack channels, but that had like the fundamental force that's at work here is not tied to Bitcoin. It's not tied to Ethereum. The fundamental force that's at work with crypto and digital assets in general, it's what I talked about at the very beginning, which it is marketplaces, or it is systems where multiple people that do not trust each other, or in fact sometimes hate each other, or don't like compete with each other, can all get involved in the exact same system at the same time, and enable really amazing use cases. Like that is the fundamental problem that like Satoshi solved, was that issue of how you trust people that you fundamentally can't trust. And so what we're seeing, like for me, this is all the best stuff came out of the crypto winter. You know, Aave, Compound, Maker came out of the crypto winter. I mean, those were the real innovations, like a maker market for a collateralized stable coin that is driven by lending and borrowing markets was a genuine innovation. You know, so, Vitalik writing his original AMM paper, you know, I wouldn't be surprised if someone like that wins a Nobel Prize in economics. I mean, the AMMs were fundamentally new models for how to do trading that no one had ever come up with before. They're going to change the world. So that for me, I look at the space that there are still companies getting started. There are people doing really, really cool stuff. The fundamentals for a lot of these businesses, from Aave to Compound to OpenSea, haven't changed. You know, the price of Bitcoin has changed. Like, you might have to belt tighten. There might be revenue differences over the next few years or the next year or whatever. But the fundamental nature of peer-to-peer, you know, decentralized finance in general, which is is the thing that I really think is most revolutionary about crypto. Bitcoin's great. You know, from a libertarian standpoint, you know, that there's nice aspects of a non-governmental control reserve currency like this. But for me, what I get really excited about is this idea that there is a mechanism by which we can take all of the financial services in the world. So the Bank of America's, the JP Morgan's, the Wells Fargo's, and essentially disintermediate all of them through this thing. And I tend to think about this in terms of like rent. So like rent seeking is this like economic term for when you create capture of markets through legislation or technical processes, whatever it is, that means that you can basically get this free rent coming out of it. The financial services industry in America has sort of held Americans in this rent state for a very long time at this point. And they kind of extract this 3% tax on everybody at all times. You know, a great example of that would be, I always go back to thinking about borrowing money on the blockchain versus borrowing money from Citibank. Not to pick on Citibank, but you know, if I go and I want to borrow from Citibank, I go into a branch. I'm going to fill out a piece of paper, put my social security number on there, all that kind of stuff. And today they're going to lend me at something like 8% interest rate. So the prime today is just under 2. They're going to lend it to me to 8. Like, there's that 6% value that they're capturing there that I don't entirely know where that's going. And I don't really like where that's going, to be super honest, right? Because where it's going is going to Citibank running mainframes. Like, they still run AS400 machines that they have to custom build. You know, you have to custom build chips to actually even like, you know, repair these things at this point. They have buildings that they own full of people that are managing spreadsheets to understand this loan risk exposure and all that kind of stuff. They have 6,000 offices, like buildings that they own across the US that have human beings in them. And so you take that and you compare it to someone like Aave, who essentially, they'll always be at prime, because, you know, why would you use Aave if you could just buy T-bills or something at prime? So they'll always be at prime, but they're like 1% above it, and that's profit. And that's reasonable. Like, no one thinks you should get profit. It's just, why are you getting 6% profit when you should take 1%? So this idea of disintermediating those traditional financial services companies that have become incredibly long in the tooth and are no longer really needed is what's so powerful about this entire thing. And that cuts across from like the DeFi example. So that's, you know, trading, borrowing, lending, collateralization, options through, you know, one of our customers does on-chain options through collateralized debt obligations and insurance. But it also extends into just, you know, it extends into other parts of the industry that are, you know, like even like OpenSea, right? Like someone like OpenSea competing with eBay. That's very real. I mean, eBay owns a big office in Palo Alto. They have a bunch of servers. They have a bunch of people that work for them. they have to run the infrastructure that facilitates the trades. OpenSea doesn't. So like even OpenSea stepping outside like DeFi is going to put enormous downward pressure on pricing and upward pressure on capabilities from someone like eBay, because they've just disintermediated all of those costs and they've changed the business model. So so none of those fundamentals have changed. It's just the price of Bitcoin has taken a big hit. So I still am a believer.
I mean, it certainly, you could hear it in your voice, when you're talking about it, in terms of being a believer. One thing I always am curious to hear from those that are closer to the industry than I, and those who are, kind of everyday working in it, is you have this kind of battle of a truly decentralized world. And where we live today, which is obviously very centralized and a lot of intermediaries. But, I do think it's a big leap to go all the way to the decentralized universe that maybe some super crypto enthusiasts would like us to go. But I do think there's a space in the middle to bring in some of the best parts of DeFi with where we are today and do some of what you were just saying, which is disintermediate and take that 6 and maybe bring it down to 1 to 2.
What's important here is this is not an ideological discussion, right? Like when I get talking about crypto, I don't spend a lot of time talking about burning down the government and things like that, because that's an ideological discussion that's not that interesting. It's a cost and an efficiency discussion. Like that's why crypto isn't going to disappear tomorrow, is because you can just drastically change the cost structure for something like eBay or Citibank or whatever it is by moving to a worldwide computer that can do this work for you, having your consumers pay the fees. Like OpenSea is fundamentally different than eBay because their consumers pay what would be like the credit card processing fees. So that's what I think what's really important about is that like you really do have to segment the ideological discussion around decentralization from the efficiency. Because when you can disintermediate Visa, like that's 3%, Yep. You disintermediate Visa from a transaction, whether you as a consumer realize or not, that's between 2 and 3% money that has just left a individual business's pocket and come back, usually like split between you and the business. Yeah. That's the real power here.
Do you think regulators and legislators understand it in that simplified of a term? Or, I mean, some of it's posturing on their part, obviously, and some of this is politics, and some of this is playing the game of Terra and
well, we'll talk about Terra in a second here.
I mean, and some of it's to get in the news, but there are some intricacies to this that they don't seem to necessarily capture in a way that's so obvious to many others. And that does complicate how the industry kind of evolves, because up until the regulators give full clarity, there is a limit to how far things can go.
Yeah, there's a couple parts of that I'll talk about. First of all, like I when you say that, I think about Elizabeth Warren, because I really like Elizabeth Warren at a high level. Like I like that we have a financial protection bureau for individuals. There are a lot of people that are not particularly well versed in this stuff. A lot of the things that we do as a capitalist society are horrific to the lower income people that we kind of deal with. So like there's terrible stuff. I always really liked her. But what she's missed fundamentally about crypto is what I'm talking about here, which is this amazing disintermediation and like bringing power to disenfranchised people. The idea that anyone could go online and take out a loan without anyone looking at your name or your color or your credit score to make a decision about that is incredibly powerful. And so I get super frustrated with her in particular, because this is a thing where a regulator like her, there are ills in the industry. Like, don't get me wrong. Like there are a lot of
ills in every industry though.
There are ills in every industry. Like there are scams scams have been around since the first time someone did anything. Like, I don't know. The first time
it's funny because we did a webinar, hour and a half ago on fraud. And we talked about, how Capital One and Equifax had, I think between them, almost 400 million pieces of personal identifiable information put out there into the dark web. Yet Capital One and Equifax and others still exist. Yet it's used as kind of this piece to the puzzle by the regulators and legislators as if crypto enables this versus it being a byproduct of almost any industry out there.
100%. So that always gets me a little bit. Is like, look at this. This is crypto can be an enormous force for good, and it will. Like there will be a lot of good done for a lot of people because we're going to be because of this 3%. We're just going to be taking out of the middlemen here. So that's the first piece. The second piece about kind of the longer term around regulation in the U.S. I mean, look at regulation isn't necessarily bad. The thing about crypto that's super interesting is that crypto has a release valve. So like if you think about Spotify exists because of how easy it was to steal music through Napster. Mm-hmm. People didn't necessarily want to steal music. And there were downsides to Napster. Like every now and again, you download something that had a virus in it, or like, if you were on certain networks, you couldn't use it. Like Napster was the easiest thing in the world to use. But it instigated a phenomenal change to the nature of how we consume media that we're still feeling the ramifications today based on this idea of peer-to-peer. And so, when I think about that, like, so that was essentially a release valve because the regulations were incredibly clear. Like it was illegal to download music. Like no one argued about that, but everyone did it. So there was a release valve on the regulation that basically forced industry to be like, okay, we're never going to beat this. We have to come to the table and be like, meet someone in the middle. And then you have Spotify. And that's amazing. Crypto is the exact same way. Like you could write legislation that made Aave illegal, but you cannot make Aave illegal. Like the decentralized nature around this would make it incredibly difficult to actually outlaw any of the advances that's happening. So there's this release valve that's built in that like, if regulators go too far, it just won't matter. It's pieces of paper on dead wood, on dead trees that we all like kind of look at and chuckle a little bit and then move on with our lives. So there is, because you have that tension with kind of the democratization of this, I think that's why you saw the Loomis bill be so reasonable. Like it's almost like the Loomis bill was incredibly reasonable, and that's weird in this kind of world. It was bipartisan and it was reasonable. And I would chalk that up to the fact that like they know they can't regulate this. What you can do is if you regulate it correctly, you regulate it in such a way that like Spotify, you regulate it to $9.99 a month, right? So like everyone was willing to pay $10 a month for unlimited music. No one was willing to pay whatever $100,000 a month to buy every CD in existence. So they would just go to zero for Napster, but they're willing to pay $10. And so that's like the trick to regulation around this is like find that point where like you have just enough, there's just enough overhead, people are paying their taxes. It's easy to kind of all do that, but you haven't gone so far that people are just like, screw you, I'm just gonna do it all anyways because I can, because it exists out there whether you want it or not.
What about the concept of recourse? Obviously, when something goes wrong at my bank or my institution, in many ways, a transaction stolen from me, something happens on the credit card, I can call someone up. In many cases, they'll give you the money back, or if they won't, there'll at least be a process, and then you'll be approved or declined. All right, based on this process, this paperwork, whatever.
Right.
The many people at least believe that that doesn't exist in crypto. A, what do you say to those that don't think it exists at all? And B, could crypto and the community at large do a better job at kind of unearthing some of this and say, hey, here's maybe some parallels that you can see that, if something goes wrong, maybe this is the steps that you would take to, kind of right the wrong to it.
Right. Well, I mean, where I would start with that is to say is that you're absolutely right, but that's not free. Like that's what you pay Visa for. Like the 3% that Visa extracts, the 2.5% that they extract is so that the once a year when your credit card gets stolen and they rack up, they buy, like last time my credit card got stolen, the guy I think he bought a bunch of sneakers. It was super funny. I don't know. Like it was just bizarre. Like I think it was all like at Champs. Like he went and spent a bunch of money at Champs.
Champs.
Just bizarre, but awesome. Like I'm like, all right, dude, get yours. That's awesome. That you're paying that 2.5% for that because then that is what subsidizes the cost of it. So it's not like it is certainly possible. There's absolutely no reason that you could not build a blockchain that has a mechanism for unwinding particular sets of transactions. And in fact, it would not even be that difficult at a very, very high level to more or less do that. And I think we will see that. I think as you see more maturation in the space, you will see that happen. At the end of the day, someone eats that cost. And so every time when you do things like that, you are just increasing cost to the point. Now, you get so many other efficiencies from crypto that I think that you legitimately could see a crypto credit card whose cost was, 1% instead of 2.5%, because that's really their fraud numbers. So like they're getting like 1.5% of profit and 1% of fraud. So you'd find something that sort of approaches much more of like the bare minimum there, rather than a pretty hefty intermediation fee because they have such a great rent over the retailers. But there's no reason you couldn't build it, and it will just be, and then it will really be up to consumers to choose, like, do I want to use the less risky but more expensive version of whatever this is, or the more risky but cheaper version, and be in the middle. And consumer choice like that is good. Like people should be able to make those decisions. Like I would use the riskier one because I feel very good about my security. So my grandmother should use the less risky one because she doesn't. And that's good. That's good for the industry.
Going back to a little bit about, kind of what you guys do and your specialty.
Yeah.
What are some of the biggest challenges that companies face when they want to bring digital assets kind of into their ecosystem, into their company? You mentioned some things earlier, for MicroStrategy, it's kind of more than just a use case. It's kind of who they are. So what are some of the other things and challenges that companies face?
At a very high level, it's relatively simple. Like, well, let me rephrase that. It's very complicated, but I can explain it very simply, which is that when you bring digital assets into your enterprise, essentially every part of your CFO org is touched. So accounting is an obvious one. So like let's say I wanted to pay you 1 Bitcoin for this awesome podcast. There's no Bitcoins were exchanged as part of this podcast, but let's say I wanted to. So it's actually very complicated for me as a business to handle that. So I go to my wallet, I send you a Bitcoin. It takes me like 7 seconds to do. It's super easy. From that, my business has actually picked up between 3 and 4 different obligations. So first, I picked up an accounting obligation. I need to book an expense. So today Bitcoin's at 21,000. I need to book a $21,000 expense. We'll call it a marketing expense into my general ledger so that I can deduct that later when I go and do my taxes, right? When I need to show my P&L, I can show, hey, we spent $21,000 on podcast expenses, whatever it is.
Yeah.
Second of all, I'm picking up a tax obligation. So the accounting obligation was the 21,000 I spent. In the way that this works in the current tax law is that spending that coin is disposition of property. It's like selling a share of stock. So I need to pick up a taxable disposition that is whatever I bought that coin at. So let's say I bought it at 30, I sold it at 21. I need to pick up a $9,000 capital loss and report that on my taxes. So I have an accounting obligation, tax obligation. I just sent you $10,000 or $21,000. In America, I need to report that to somebody. I need to do a 1099 NISC to you, an I-9, a W-8. Like there's a bunch of different things that I might have to do to report that $21,000 transaction. So I picked up a compliance obligation. And finally, if you're following US GAAP, you also have an obligation to track a separate accounting cost basis that potentially has different implications than your tax cost basis. I won't get into all the details now, but you basically have a separate obligation there. So this one little 7-second transaction turned into like 4 different obligations for a business. And that's where this gets really, really, really tricky. So Bitwave has this one tool. We can see that transaction. You go in, you tell us what you use it for. That also takes about 7 seconds. So it's kind of like commensurate with how long it takes to spend it. And then at that point, we now can handle all of your accounting work, all of your tax work, and then all of your US GAAP work in case you need it in compliance stuff. So that's the basic idea is that crypto transactions create a lot of obligations that you need software to kind of deal with. There's a lot of other stuff there though. once you get into like the treasury group, your treasurer has a lot of other problems. Like at a business, this is one of those things that you might not know a lot about the treasury group at a lot of businesses. But the way that they work is like normally you have this treasury group that's responsible for your bank accounts and for kind of how they deploy the cash to conserve capital. Like what money market fund do they put it in? Or do they put it in like some sort of bond, or like what do they do? Yeah. When you get to crypto, they also are potentially responsible for the wallets of the organization. So this is a totally new function for a group of people that spend all their days thinking about very like 1% or like 0.01% yield off of their USD holdings. They're now thinking about, well, what's happening? How are people spending money? How are people using their assets? Like what happens if like one of our developers runs away to Antigua with their wallet? Like how do we make sure that we can recoup that? Because we as a treasury group have the fiduciary duty for making sure we have access to that. And it just keeps going down the line. Like every part of the CFO stack has a different issue around crypto. And that is sort of where we come in, and we have solutions for all of them up and down the entire stack.
How aware are enterprises to those levels of complications that like hearing you explain it, and you did a phenomenal job kind of breaking it down in one transaction, seemingly one transaction, which then has endless amounts of touch points. But when you're talking to enterprises, does that scare them? I mean, do they look at that and go, whoa, like, yes, crypto offers, a ton of potential for our business, but it also offers all of these current issues that maybe we didn't understand going into it before we talked to you.
Yeah. You have two different types of businesses, right? Like you have the businesses where the product team is gonna drive forward no matter what. Like you think about like the big tech companies, right? Like Microsoft has never like started to get into a product and then called their finance team and be like, hey guys, is it okay if we do this? Like, no. Like they just go and do it, and then finance plays catch up. So you have those kinds of businesses where like Microsoft's a good example. I'm sure they're going to do stuff in crypto here in the near term future. Mm-hmm. They're going to go do something, and their finance team has to be able to deal with it, whether they like the complexity or not. Yeah. So that's sort of one part. And a lot of those, like we get a lot of people like that. They're like, hey guys, our business just got into, they just opened up an NFT marketplace. Like, what do we do? And then it's this consultation. Like, and we were joking earlier about, or like, I often joke about like, it's like Accountants Anonymous, where it's like, you get this group of people together and like, it's just kind of like sitting around talking about your feelings a little bit, because this stuff is hard. It's complicated. It's tough, but you still have to deal with it and move on through life. There are some businesses out there, like regulated industries, the JP Morgans of the world, the banks of the world, they tend to be ahead of their coverage there. So their finance team tends to be a lot more of a gatekeeper. So for those guys, we get brought in a lot earlier to explain things, to work through it. You have all of your accounting is figured out before you get into before Bank of America will ever offer a crypto product, every single tax and accounting thing will be figured out. Yeah. It'll all be done. It'll all be ready to go. So you have different types of businesses, but everyone is generally surprised by the complexity when you really get into it.
You mentioned stablecoins earlier. Kind of what are your thoughts and A, some of what's gone on in the space, and B, I think there's been a lot of, I don't know if intentional misinformation, but there's been a lot of information out there that has thrown this black cloud over stablecoins when it's really a certain type of stablecoin that's proved to be a big issue, and other stablecoins that maybe aren't backed by the assets they say they are and have kind of gotten themselves in their own
a little bit of
mess
trouble.
A bit. Yeah.
At the end of the day, stablecoins are an incredibly important part of the ecosystem. So that's where I'll start here is that crypto would not be where it is today were it not for Tether, like to give credit where credit is due, because like Tether's been around for a long time at this point. So like crypto and DeFi would not be where it is today if not for Tether, and DeFi would not be where it is if not for USDC. Like USDC runs DeFi in many, many ways. Like we don't really think about it that way. We think about it as Ethereum. We think about like, whatever chain you like, but realistically speaking, USDC is the lifeblood of a lot of DeFi at this point. So stable coins are an incredibly important part of crypto. What I I didn't, the way I tend to think about the whole Terra UST I think fiasco is probably the best way to say it, is that it gets back to this ideological discussion. Like, crypto is rife with ideologues who sort of think very deeply about the decentralization aspect. And so a stable coin like USDC is necessarily centralized. Like, it is centralized. Coinbase at any moment can stop your funds. They can take money away from you. They can do a lot of stuff. It is a centralized protocol by design. The goal of UST was to create a completely decentralized stablecoin. And a good analogy, if you think back to like where this is, we're kind of in a research, we're in the research mode for stablecoins. Like, everyone is kind of working on it. A lot of people in the decentralized world want there to be a decentralized stablecoin. We want to figure that problem out because it means that you don't have this reliance on centralized authorities. It means that you can't have the government. Like, if the US government made rules about stablecoins, USDC could be shut down, and reasonably could be shut down. Like, they could set up something where you can never spend it. You could only send it to them to withdraw USD off of it. So there's a lot of value in having a stable coin that cannot have that happen to it. What happened with UST, in my very humble opinion, it's kind of like what happened with the DAO. If you remember the DAO back in the day, this was the very, very first DAO that ever started. It was a toy project. I mean, it was a cool project, but like, this was a group of people that thought they were going to raise like $500,000 and ended up raising like almost 100 million, right? And it's one of those things where like the difference between how you write your code and how you build your product and like everything that goes into it, it's a real big difference between a $500,000 thing and a $100 million thing. So the DAO they weren't ready for their success. They weren't ready. Like, it was a super fun research project that, when it was actually a real $100 million project, obviously failed for security purposes. I kind of think that's what happened with UST here. Like, as a fun little like $500,000 project, it could have been really interesting. It was interesting research. It was interesting ideas. Like, could you build a treasury that could support the price through liquidation events? Like, there is something like, because it was a quasi collateralized stable coin, but not quite. So like, could you do that was an interesting question, but like, they were a failure to their own success, which was like, at the point at which you were $1 billion, you had $1 billion or whatever they topped out at. It was never going to work. Like, you could not do it at that scale. Like, you did not have the collateral to support the market against the movements. It was completely untenable. I think it's really important we continue to do algorithmic stablecoin research. I think someone will get it right someday, but it would behoove us as an industry to do more small research projects and less like Do Kwon projects where you're like trying to show that you're the next big thing. It's really stupid. Like, it was always a hard project. It just should have been a lot. They could have been a cool research project, but it blew up.
So we have a few minutes left here, but tell us more about those around you at Bitwave and the team that you've built.
Oh wow, that's a great question. It is just one of the most amazing teams I've ever had the benefit of being involved with. And it's hard. Building startup teams is super hard. Like, again, getting back to the startup philosophy here, it is hard to hire people who are also interested at that junction point of risk and reward to get involved in this stuff. Now, crypto is great because a lot of really smart people like crypto a lot and have wanted to get into crypto. So like, we've been able to build a really good team. My co-founder's name is Amy. She was my co-founder of my previous company. She is a rock solid operator, really good, tactical thinker. For me, I'm a little bit pie in the sky, head in the clouds sometimes. And when you have people like that, you want to pair like the person who's always thinking about the future with the person who's thinking about today and tomorrow. So I always joke with her that there's some huge catastrophe is on the horizon, and I'll be like, oh, it always works out. It should be like, well, yeah, because like, I'm around making sure it always works out. So it's an important part of a founder co-founder relationship is to have that person around you who always makes sure it works out. Some of our early hires were, our director of engineering is a guy named Tej. Really, really, really great director of engineering, came out of the financial services world. Ore Phillips is our VP of product solutions. Absolutely spectacular operator. Again, it's one of those things that you only can have so many people like me at a company. You need to have a lot of other people who are very, very tactical, very like execution-minded operators. Ore is a person like that out of PwC, one of the sharpest guys I've ever worked with my entire life. We have built he's built a really good solutions team that does kind of the day-to-day support work from Bitwave with our customers. Amy's built a great sales team that does the day-to-day selling side. Jim's our director of sales, who's done a great job. He came also out of the fintech world as well on that side. It's just been really fun. Like, it's hard to hire. We've had the most success with referrals, I think, and maybe some of the crypto boards, because people from the crypto boards are pretty passionate about the stuff. One of my best hires, we hired off of Reddit. Like, I swear to God, like, someone posted a really interesting project on Reddit, and like, we need to hire this guy immediately. One of our best hires from that side. So, if you're hiring in the space, the only advice is be creative.
Do you find that there's a lot of people who are acting more knowledgeable than they might be, especially in, like, it's not like crypto's been around like banking for 100 years. It's still relatively new. And so do you find that there is this kind of avenue of people who know enough, but maybe don't know the amount they need to know to help build a long, sustainable business?
I think it gets back, like, this is like the third time we're going to talk about ideologues on this stuff. It gets back to that, which is like the people who tend to be the most ideologically driven. It's nothing against them, but they tend, if you're looking at this from an ideological standpoint, you tend to gloss over a lot of stuff. You tend to think about the way that crypto will change the world. You tend not to think about why crypto is the way it is or what it's used for. So something that I always talk about, like, this isn't meant to insult the community at all. I find the Bitcoin Cash community really, really interesting, because about half the community is really obsessed with this idea that Bitcoin Cash is the true Bitcoin. And they spend a lot of time talking about it. And they spend a lot of time, I would say, pontificating on that and like bagging on Bitcoin in general. But then the other half of the community has sort of embraced this idea that Bitcoin Cash is a fundamentally different asset, which is much more designed for spending rather than for kind of a store of value and anti-deflationary mechanisms. So it's one of those things, like, where when you start getting super wrapped around the wheels about your project, or like the competitiveness of your project versus another project, that's where you run into issues. At the end of the day, every crypto has pluses and minuses. The nature of designing a decentralized Byzantine resistant system is that you are making choices and trade-offs between it. So Bitcoin is designed to be an incredibly slow moving, incredibly stable protocol that is small, that can be transferred. Like, I don't know if you like the Bitcoin satellite. I ran to Adam Beck when I was in Consensus, and the Bitcoin satellite is still up and running. Like, you can still set up a satellite to receive Bitcoin nodes, and now you can do a full sync of the entire blockchain off of it. That is a particular thing that says, like, hey, if you're in a war zone in Ukraine and someone decides to shut off your internet, you could still use Bitcoin. That's crazy. Like, that is incredible. And that's what they've designed it for. Like, that is what they have designed for, the very foundation. So, like, use cases for crypto are super important. Ethereum is designed to be a worldwide supercomputer. Dash is designed to be an instant payment system. Bitcoin is designed to be a store of value. Bitcoin Cash is designed to be a payment system. So keeping that in mind, like, where I find people get very wrapped around their tokens or the projects that they care about, and they tend to think that it can be the solution for everything for everybody. And that's not the way you should think about crypto. Like, you should find what the different projects are good at. And if it's not good at anything, then that should also tell you something. Like, if it's not anything special, that tells you something. But if it's designed to be spendable like cash, that should tell you something. If it's designed to be stored, that should tell you if it's a smart contract. So that's how I tend to think about this. And that's where I hope that's where you want to, like, kind of separate the people who are thinking deeply about this versus the people who are just kind of like, wrapped around their own token.
I would think the more the better. I mean, the more innovation, the more potential projects. Some will fail, but the more you have, the more potential opportunity that's out there.
Could not agree more.
So we have just a couple of questions to end with here. A little bit lighter, a little bit more fun. Do you have a favorite book and the last book that you read?
Jesus Christ. Probably my favorite book, if we're being honest, is Hitchhiker's Guide to the Galaxy. Because probably my favorite book. I like just the most amazing book ever. Like it's still like I've read it like 20 times and it still consistently makes me laugh. Last book I read was Dune because I wanted to reread it before watching the movie. And it holds up really well. Like Frank Herbert was an amazing author. Like that book holds up spectacularly well. The only book I'll offer one book for people that are interested in startups, because we spent a little bit of time talking about startup theory. Yep. I find Peter Thiel to be he's a very divisive character, and he's a bit tiring, and he's an odd duck, I think it's fair to say. But his book 0 to 1 is probably the best startup book for anyone that's really thinking seriously about startups. Because it's the foundation of the book is it's like there are two types of business endeavors that get started. There are businesses that are incremental changes, and there are businesses that are foundationally reinventing a new market. Like, so a business that like is reinventing a new market is taking a market or a problem from 0 to 1. Those are startups. Those are companies that can grow into $1 billion companies. And so he does a really good job just articulating that, walking through how to think about it. So for anyone who's serious about startups, it's a great book to read to make sure that you are correctly assessing if this thing that you're about to start is an incremental improvement, which is totally fine, but you should think about that problem differently. You should fundraise for it differently. You should deploy capital for it differently. You should hire for it differently. Or if you're building a truly 0 to 1 type product, which like I consider Bitwave to be very 0 to 1 because it's rewriting how finance teams work at organizations. If you're doing something more like that, then you need to fund it differently. You need to think about it differently. You need to design your company culture differently, everything. So those are my 3 book answers.
What do you do to kind of step away, unwind, to kind of unplug?
I don't know. I'm not good at it. I should be better at it. It used to be travel. Like I'm a big fan of travel, but obviously the pandemic put a big stop to that. But like I was doing a thing where I was going to all the national parks. So I got up. So there's 63 national parks. I've done 30 something, almost 40 of them. So that's cool. Like I love travel. I love the national parks in America. I love like hiking and camping and all that kind of stuff. So I'd say that's probably part of it. Anymore in the post-pandemic world, I don't know. Like I go for drives. I just like get in the car and drive for half an hour just to like turn your brain off a little bit.
Do you watch sports? Favorite sport teams? Sports?
Let's go Warriors, man.
Right.
I do. I'm probably my number one team would be the Niners in terms would be NFL for the Niners. And then I went to USC, so I'd say my number 2 would be USC football.
You should have told me that earlier. I'm a Notre Dame fan. So.
I'm glad we got through the whole interview without that one coming up.
And then final question: biggest inspiration in life?
That's a really good question. I mean, I've lived a very lucky life. Like I've had amazing people around me. My folks are incredible. My dad was an entrepreneur. My mom is a dietitian, registered dietitian. So she works with like, people who are in need. My dad has been an entrepreneur his entire life. Like they both inspired me quite a bit. My aunt was probably my first person that was in computers in my life. My dad too, both of them, but they inspired me quite a bit from that side. I think that like stepping outside of family, Bill Gates was always a pretty big inspiration to me, just in terms of like who I really respect. I mean, him, like all those guys, it's saying respect is a very interesting word for them because they're like at the height of, whether it be Steve Jobs, Bill Gates, any of these guys, at the height of their power, influence, whatever it was, they're all kind of nasty mofos. I mean, like Bill Gates is notorious for bringing engineers into these review meetings and like just like tearing them apart, tearing them down to their bare bones, and people like walk out of meetings crying. But I think what's always inspired me about those guys, and Steve Jobs falls into this a lot, like the Walter Isaacson book on Steve Jobs is a phenomenal one to read, because there was a lot of stuff that I did not realize in there. Obviously, like Steve Jobs is nuts, like later in his life, and some of the vegan stuff, and like not wanting to get medicine for pancreatic cancer, like just like pretty far out there. But then Steve Jobs also took every last dime he had and put it into Pixar. It's incredible. Like, it's almost unbelievable to do that. Like, he was, this was after he left Apple. He was worth $250 million. And he put every last dime like into Pixar. He bet the entire house on himself. That to me is, and Bill Gates is sort of very, very similar. I mean, like, these are both guys that like made very large bets on themselves that paid off handsomely in the end. But that to me is very inspirational. I like thinking back to those guys and how they got their starts and what they did. Whenever I'm having tougher days in the startup minds, I think about Steve Jobs betting $250 million on Pixar. Just crazy.
Well, Pat, I greatly appreciate you giving me some time today. How can, if the audience wanted to find you guys and how can they do that?
Absolutely. So you can find, so for Bitwave, if you are a business that has any need for digital assets or just wants to talk about it, go to www.bitwave.io and you can get in touch with us there. I'm on Twitter at Pat White. I've been on Twitter for a while, but I don't tweet a lot, but that's me there. Feel free to reach out. And then if you want to email, just info@bitwave.io is the easy way to get to us.
All right. Well, Pat, thank you very much. Continued success to you and the team. Hopefully we'll get you back sometime.
Awesome. Thanks so much, Todd. This was an absolute pleasure, buddy.